Great. So we're recording now. Welcome, everyone. My name is Andy Reed. I'm a director with Propel and a registered representative with Hubble Investments, Inc., our broker-dealer subsidiary. I'll be opening today's call, and we'll start with a few housekeeping items. I'd like to start by letting everyone know that I will be recording the call, and a copy of the presentation will be made available after the call. Before we begin, I'd like to remind everyone of the following information. Propel is a funding platform, not a broker-dealer. Securities offered through Hubble Investments, a member of FINRA SIPC, and an affiliate of Propel. Private investments are highly illiquid and risky, are not suitable for all investors. Past performance is not indicative of future results. You should speak with your financial advisor, accountant, and/or attorney when evaluating private offerings. Neither Propel nor Hubble Investments makes any recommendations or provides advice about investments. The information you hear about today may contain forward-looking statements about investments which have not been reviewed by Propel or Hubble Investments. You should not rely upon these statements and should carefully evaluate the offering materials in assessing any private investment opportunity, including the complete set of risk factors that are provided for your consideration. Now that I've attended to my basic housekeeping duties, I'd like to say that Lisheng Wang, co-founder of Propel, will be moderating today's call. For those of you on the call who have questions, please use the Q&A box located at the bottom of your Zoom panel to ask any questions, and I'll be reading them out after our initial discussion. So with that, I will sign off and let the conversation begin. Thank you, everyone, for joining today.
Thank you very much, Andy. That's a very thorough opening. Thank you for that. My name is Lisheng Wang, everyone. Thank you for joining today. As Andy said, I'm one of the co-founders of Propel, heading the investment platforms and investments. I'm also managing director of our early stage deep tech seed fund, Newton Fund. So Propel is the online investment community that squarely focuses on deep tech investment opportunities. And we strive to bring investors the quality deep tech early stage investment opportunities. Over the past 5 years, we have closed around 80 plus rounds of financing for a deep tech early stage investment financing. We also announced that the Propel startup families, we had enjoyed 1 exit in Europe stock market, as well as 6 acquisitions. Today, I'm really pleased to have 2 longtime venture capitalist veteran here with me, Ben and Rajesh. And I think the firms they come from, Sierra and Khosla, don't really need that much introduction because those are really successful venture firms squarely focused on, I think not squarely focused on, but has put a lot of emphasis on deep tech investing, especially to individuals today here. I think it won't do justice if I don't give them a really brief introduction, even though they are really well known in the space and they turn out to be really successful after different economic cycles and downturns. So they are really fit for this topic that discussed with me about the change in trend of venture investing under COVID, or how these industry or ventures have adapted under the current environment. So first of all, Ben is one of the managing partners at Sierra Ventures. Sierra is actually a firm with 38 years of history, almost from the very beginning of the venture investing in the Silicon Valley. And Ben has been with the firm for 21 years. And so he's really veteran in the venture investing industry. He led investments in numerous successful deep tech hardware companies from their early rounds through IPOs such as VeriSilicon, InverSense, as well as Authentic. And his current investments include companies in 5G, wireless, 3D printing, quantum computing, sensor technology, robotics, and many others. So switch over to Rajesh. He is a partner at Khosla Ventures, focusing on hardware-driven deep tech opportunities. He was previously the head of Applied Ventures, a venture arm at Applied Materials, a $300 million fund where he invested in AI, AR, VR, 3D printing, clean tech, healthcare, and other hardware-driven deep tech opportunities. By the time he left there to join Khosla earlier this year, the fund had over 90 companies across 13 different countries in their portfolios, with many successful acquisitions and IPOs. I really respect the 2 investors. Not only they came out as successful investors through the different economic cycles, but also many of their successes come from deep tech sector, which it turned is supposed to be kind of a much harder investment area. I'm really happy to have them on the call today. So I have a few slides just to set the foundation for the discussion today. Let me share my screen right now. Can you guys see my screen? All right, cool.
Not yet. I don't.
Is it showing up now?
Yep.
Okay, thank you very much. All right, first of all, thank you, Ben and Rajesh, to join us today. And I've walked through the introduction slides. And so the next slide is really, a lot of us probably are very familiar with the two maps, and these indeed come from Johns Hopkins. The reason I'm putting it here is to show that the magnitude of the pandemic on mankind. And this definitely turns out to be one of the worst pandemics since the Spanish flu in 1918. And still today, I think there are a lot of new cases. The point here is, even though that I think we are more used to the pandemic, working or living in pandemic now, but I think it very likely is not going to go away overnight magically. And also, even after the COVID, I mean, the way that we live and work is going to forever changed. With that, there are going to be interesting new risks and opportunities that presented to ventures and venture investing. And then shift over to kind of the global economic view of the, caused by the past recessions and this one. So the reason I'm actually showing this slide is just give you a kind of magnitude comparison in the GDP decrease. So if we look at, the last Great Recession in 2009, the financial crisis, I mean, we can see actually a drop of about 5% in GDP year over year, or quarter over quarter. But if you look at Q1 and Q2, the 2 quarters GDP decrease, that's pretty significant, come to 9.25 and almost 32%. So of course that's caused not only by the financial kind of impact, but also a lot of physical activities being stopped. And with that magnitude of economic impact caused by pandemic, and how does the venture space fare in such situations? First of all, let's look at the last recession, right? This is the venture and angel investing activity comparison from 2008-2009 period. So as we see the early stage and late stage investment, these are primarily institutional investments, right? From VC investors, from large corporates, from private equity firms. And we can see that these institutional investors have been fairly cautious during this time period. And we can see that both the deal volume and deal value has dropped, to about, in 20-30% range. But the early stage investing are still fairly resilient, at least through the past downturn, which turned out to be fairly successful, just because we had a lot of successful companies that now everyone heard about, like WhatsApp or Uber, or I think Instagram and some others really come from that batch. So as we can see, as institutions slow down a little bit, I think angel investors are still fairly active and turn out to have benefit from these investments. So this year, things haven't really changed that much, I would say, so far. The first half of 2020. If you guys are looking at this chart, the 2020 numbers are half-year numbers. So it's Q1 and Q2 numbers. If you look at that green bar, the green bar at the bottom, so that represents the angel investing value. So the amount of cash or money have been invested in early stage angel round deals. So if you compare half-year number to 2019, we're almost, I think, 60%, 70% there compared to 2019 in just 6 months. So we really haven't seen early stage investments slow down from the individual or angel investment side. Institutional side, I think we do see a little bit drop on the investment count side, and the value also down a little bit. On this slides, as we can see, the Q1, Q2 number, we didn't really see a significant hit in Q1, just because I think the pandemic didn't really spread that wide in the US in January and February. But starting from March and April, you start to see the Q2 numbers that did get a pretty big hit in institutional money sector. So the early stage VC deal activity by volume as well as by value have dropped in Q2. But where did that drop come from, right? I mean, was that coming from really that VC cannot raise the additional funding, or was that really coming from kind of the typical a little bit kind of conservative view right after the recession from the institutional side? So the answer is actually VC did raise a lot of money. Not only in the past couple of years, 2018 was the historic year of VC's funding, right? VC funds raised tons of money. And just look at the first half year of 2020. And just in 6 months, various VC funds globally have raised about 80% of the funds that VC collectively raised in 2019. So this year, we might see another historic year of VC funding raised. So the decline of early stage VC investment activity does not come from the fact that there's not enough dry powder on sidelines. In fact, the difference of this, I think, recession in the VC sector is that we do have a lot of investment capital on the sidelines. But I think these guys, I will let Ben and Rajesh talk more about those. But I think VCs are more cautious right now and more selective in terms of the deals they are investing into under COVID. And finally, this is one of the reasons why I said that some of the angel investment might paid off. If you look at this chart, right, this chart basically shows that the investment returns right after the two recessions, previous recessions. One is the 2001, the dot-com bubble. And then the next one is the 2008 financial crisis. Right? If you look at the 2002 and 2003 year number, the realized return has jumped quite a bit right after the dot-com bust. That means if you have invested right after the dot-com bust, and the return on average could be pretty promising. And then in 2008, we see exactly the same thing, not to that magnitude of dot-com bust, but if you did put some investment, of course, in a portfolio kind of fashion, that you could see your return, a pretty good return after the financial crisis. So I think the takeaway here is if history repeats itself, oftentimes it does, even though we are in one of the worst recession, in the century, but very likely we're going to see some really good ventures being built over this time, as well as some good investments being made in this time as well. So that's enough with my kind of macro view of the economy and also the impact to the venture world and venture investing world. So I think everyone is anticipating a kind of a good discussion between Ben and Rajesh and me about the new norm of investing under the pandemic. First of all, let me just open with one question. I just talked about kind of the Wall Street analyst view of the whole thing under pandemic. It's more like the 30,000 mile view. I would like to ask you, Ben and Rajesh, because you guys have more of a micro view because you guys are in the trenches working with companies, investing in them every day. So do you actually see a difference in the micro view of what you have experienced every day versus that macro view of the VC investing trend? I'll begin with Dan.
Yeah, well, first of all, thank you for inviting us onto this panel. It's always good to be involved with Propel X, quality firm, and we do a lot together with, so appreciate that. In terms of the views, I'd like to share some data first. Maybe that's helpful. I'll start with the capital inflow into venture capital. Compared to last year, the number of funds get formed this year has not seen a slowdown. So there's plenty of capital coming into venture capital. It favors the existing firms instead of the newly established firms, which is as expected. But the total amount of capital and total amount of firms that gets funded is no slowing down. And without going to great details, I would say the way we do investments through the pandemic is a little different, given the fact that we're working from home. So due diligence is a little different, sourcing is a little different, getting to know entrepreneurs and all that obviously is a little different. But having said that, I would say right now is as competitive for talent and for good companies as I've ever seen. As most of you know, the YC summer class had just ended a few weeks ago. And I would say the competition for the top companies for this class is more fierce than I have ever seen. So on that front, I would say this is still a very hot market right now.
Yeah, thank you, Ben. Also, I think one of the earlier charts that I show, even though I think the venture number of deals that did go down, but if you look at the value in the angel investment space, let me go back to our early slides here, and I just resonate with Ben's point, is that if you look at this chart, right, in 2020. The value, the dollar number that invests in the early stage angel around stage, and the value is still there. I mean, it's more than 60% of 2019. But if you look at the number of deals, 886, that's definitely only 1/3 of last year. That means the dollars are flying to, I think, more expensive deals. So sometimes you can correlate, the deal, valuation to the quality of the deal. So it's kind of almost like a sense of kind of flying to safety here, that we see better entrepreneurs, better deals are raising more money at a higher valuation. So money is still there, but I think the people are getting more picky and more selective. So Rajesh, what's your view on that?
I strongly agree with Ben. At a very high level, if you look at it, broadly, there is a very strong interest in technology. You can see it in public markets. You can see how e-commerce has exploded. Health technologies related to COVID and everything else is making a huge difference. And there is starting to be some good liquidity in the SPAC and some good IPOs as well. So there is good opportunity and good recognition that technology is going to be very, very critical, even more than what we thought before COVID. That said, some sectors are getting a lot more traction and some are getting less traction. That's on the industry side. If you look at the financing side, we certainly see some corporate VCs pulling back, some new funds, at the end of their fund cycle, being cautious, and to some extent, latter makes sense. Why the CVCs are slowing down, that doesn't make sense to me. But there are certainly a lot of new funds coming together as well. So overall, I would say, there is a lot of interest for good technology companies, good financing available. Just from a Khosla Ventures perspective, we have probably approved about 20 investments just in the last 4 or 5 months. These are completely new investments. So we are, significantly accelerating investments in new areas, doubling down on our portfolio companies. So if any, it has been more busy than in the past.
Yeah, thank you, Rajesh. So that leads naturally to my next question. I think Ben has already alluded to that. There's been some changes. Maybe there's something that has not changed or should not be changed in the investment criteria. So I'll maybe lead with Ben, since you already kind of touched on that topic, then move on to Rajesh. So has there been any changes in your firm's investment criteria since the pandemic?
Yeah, it's interesting that we started a brand new fund, very first deal at the end of February. And then obviously by mid-March, the world became a little different place. And my team is working from home. And that sort of shifted how we look at the engagement with new companies and how we think about what companies could be done, if my investment team is doing it over Zoom, etc. The net result is prior to the pandemic, we do 2/3 of the investments in classic, so Series A and early B rounds. That's bulk of the investments that we do. And then maybe 1/3 in seed stage companies. And with the pandemic, we favor the other way around. So our deal pace is actually a lot faster than prior years. In from March, I think we have closed 16 new investments, which typically is the whole year's tally. We normally do about 15, 16 a year, and now we're doing it a little faster, almost twice the pace right now. But 2/3 of the investments are in seed stage. And there are a few reasons for it. First of all, when we are writing a seed round check size, the level of due diligence doesn't need to be as thorough as investing in a company that has a 4-year history. Second is, when it's an idea, it's easier to qualify without going to great analysis to do, but it does favor entrepreneurs with a track record, and I would say out of the 18 investments that we have done, probably 70% are in entrepreneurs that we knew from the past, or our co-investors know them from the past. So it does favor the known quantities and the unknowns.
Right. Thank you for that. Rajesh, what's your view on this question?
Yeah, from an investment criteria perspective, some things don't change and some things do change. Things that don't change are we invest in seed and Series A. So these are long-term technology risk bets, right? What happens in the next 12, 18 months really shouldn't make a big difference in terms of the kind of things that we want to invest in that have a horizon to come into the market in kind of a 3-5 years. In fact, I would almost say to Ben's point as well, if you're a seed or Series A company, you should be able to raise money now with the right technology, because you're not dependent on customer revenues, pipeline, supply chain issues, and all of that stuff. So you're really weathering through the COVID period while focusing, head focused on kind of product development, technology de-risking, everything that you can do, regardless of what is happening in the COVID-related market, provided you have the right financing. I think the quality and the depth of the diligence doesn't change much. We're still going deep into the technologies, IP assessments, bringing experts to look at some of these things. What certainly changes is certainly making sure these companies have sufficient cash runway, particularly for Series A kind of investments. When you're investing in the companies, making sure we have good syndicate partners, good investors in the company. And the quality of the team also matters, to Ben's point, because we want to make sure you have 1 or 2 people in the team who have weathered through this storm in the past, who know how to deal with this, who know how to create the right milestones to make this fundable in the next milestone 12, 18 months down the line. One thing we certainly look for is for Series A, Series B companies, the customer pipeline matters. If you're tied to kind of an aerospace or automotive, we tend to have the companies look at other markets, and I can talk about it later. But just in terms of where these companies focus on the next 12 to 18 months, we put a lot of criteria on that, so they're not struggling with the wrong partners at the end of it. Hiring certainly becomes difficult in these times, particularly because if you're trying to bring top-notch leadership team from a large company, people are in more cushy jobs. They want to take less risk with startups at this point. So hiring becomes difficult. At the same time, I would say it gives a higher bar, because now people are not jumping from big companies to small companies just because it's the next hot thing to jump into, but because they are really passionate about it. So you can really filter people, identify the right people, and bring the right passionate entrepreneurs into the company in these times than in better times.
Yeah, thank you for that input. I think both of you mentioned something that we had the same feeling here at PropelX too. Is that I think initially when you just had an idea and maybe have some kind of good research under the data, under the product or the technology, and with a solid team, the raising funding is kind of a little bit easier than when you really have to show a commercial traction. And COVID-19 really hits on that, right? Hits hard on that. So if you don't have a good, strong team that has been through ups and downs, especially if you have experienced entrepreneurs that have gone through the last couple recessions, that definitely would make fundraising a little bit easier. So I do see that we already start to have questions coming in. So I'll just let the audience know that just not to interrupt the flow of the discussion, we'll leave the last 10 minutes, 5 to 10 minutes for questions. So if you have, we don't have a whole lot of time. So if you do have questions, please post it here as soon as possible. We'll go through it in order. So the next question we have is, I think this is something that a lot of the investors come to this panel to want to listen to. It is the interesting sectors, right, that you guys feel like could benefit from this unfortunate event. You know, on the Propel side, we definitely see kind of medical, you know, diagnostics have been really popular. Not only just, you know, because it has clearly been something that's in the center of focus, because now we need quick diagnostics on a lot of different things. But also, I think, you know, just people's awareness of having something there ready when the next thing hits becomes more and more, I think, you know, clear. So I think with that, I want to pass on to you guys, because you guys are not in the medical space. You guys are on the other side. So what are the sectors you have seen that could potentially benefit from this?
Yeah, maybe I'll take this one first. So the way we think of this whole change or the sectors that start benefiting, I think there are a lot of digital transformation that were happening anyways, and even before the pandemic. But what the pandemic did is it accelerated a lot of these transformations, and you know, things that were going to happen eventually anyways. But once the pandemic happened, it forced consumers, it forced enterprises to make changes faster than otherwise it would be, you know, comfortable to do. And obviously in the consumer world, you saw that you know, it took companies years trying to get people to, you know, order food for delivery instead of, you know, go pick it up or shop in grocery stores. And then all of a sudden, everybody is comfortable with delivery to the home. And, you know, technologies such as Zoom, that was, you know, relatively niche, all of a sudden, this becomes the mainstream technology, and people conduct meetings with cameras on much more comfortably. And so the obvious ones aside, the other sectors that where we see slow adoption before the pandemic, and then all of a sudden things started to ramp up, that is not as intuitive, are things like automations for manufacturing. We have a couple of companies that manufacturing sector is notorious for slow to make changes. When, you know, you give them a great technology that makes perfect sense, it's a no-brainer technology to adopt, but customers are comfortable doing things the same way they used to do for 100 years, right? And then the moment they realized they couldn't send workers into the factory like the way they did before, all of a sudden automation, robotics, and all that stuff becomes much more appealing to them. So I would say automation for manufacturing is one sector that is benefiting quite a bit from the pandemic. And I think once that change is made, the first step is taken, there's no going back. So I expect my companies continue to see that acceleration. The broad category of online services is definitely happening. We have companies in telehealth, wellness, education, and many different things. Now, all of a sudden, everybody look at that as the only way to keep yourself fit, or, you know, when you're feeling sick with something minor, you don't want to take the danger of going to a hospital in the middle of a pandemic when you just have a headache. And so telehealth is taking off. So there, I can go on and on and on, but you can almost think about all the things that was moving slowly and you knew it makes sense, it just takes maybe 10 years to do. Now maybe it takes 2 years to make that transformation. So there's huge benefit to the technology sectors, and therefore you see this sort of counter-cyclical, you know, behavior happening for venture capital compared to the overall economy, because things are moving from offline to online.
Thank you, Ben. That makes a lot of sense. Rajesh, your view on that?
Yeah, so we're big investors into healthcare, into medical devices, life sciences companies. That's seen a huge surge. Things that used to take a couple of years to get FDA qualified are going through an accelerated EUA approval process. So that's helping a lot of companies, you know, finish their work, get it qualified, and have diagnostic devices and telehealth services. Robotics, to Ben's point, you know, we have a whole bunch of companies in robotics, cameras, imaging, automation, and companies that have shut down their factories are using this time to kind of bring in the next advanced technology to accelerate some of the adoption that they were looking to do earlier. Also with social distancing, people planning around social distancing in the factories, they're looking at how robotics, can address some of those issues. People are, we are also seeing a surge in kind of ag-tech, food-related investments. People are becoming more conscious about what they eat and the impact on the society. We were one of the early investors in some of these areas, and those are getting a lot of traction, a lot of growth opportunities now. The other area we are seeing a lot of traction is also, what we call as a concept of hyper-local manufacturing. A lot of supply chains are disrupted. So a lot of companies, want to have local supply chain manufacturing capabilities. So from that perspective, some of the 3D printing companies we have invested in are getting a lot of traction from foundries who want to locate their entire facility within a particular geography, and not just in the US. These are happening across the world. Like Ben said, online education is getting traction. Voice and video integration is a big phenomenon. Interestingly, esports is also picking up a lot. So we're seeing adoption, very rational adoption across a lot of verticals. So it's a matter of, working with the right investors, figuring out, what you're focused on, how can you be part of this trend, but also figure out, once this COVID passes, do you still have a viable business model, and how do you plan for the future, and not just be caught up in what is going to happen, what is happening in COVID, because that's maybe a 6, 9, 12, 18-month trend, but you need to be a viable business even beyond that. So there's a lot of interesting dynamics happening here.
Yeah, I believe the entrepreneurs sitting in the audience must be, fairly happy, because it sounds like you guys are very, very busy. And in terms of sectors you guys are investing, I didn't hear a whole lot of kind of, being impacted by this pandemic. On the other side, it seems like there's a uptick in terms of investment activities for you guys to go in early stage. So maybe let me shift to my question a little bit, because you guys, let me ask this question. So you guys talked about, I guess, the investment opportunities, right? It sounds like a lot of the sectors are still getting VC attentions, but some are the real problems there. Some of the real impact that COVID-19 has had on your existing portfolios, as well as, I guess, some of the sectors that you previously might think it's interesting to invest, but now you do see that might not be the right investment for you under COVID. So on the other kind of the other side of the equation, right? I mean, these are the companies that we like to invest, that we think there's a promising future for them. But then these are the companies that we previously think might be interesting, but now it really gets a hit from COVID-19. So Rajesh, do you have any views on this?
Yeah, I think there was significantly more uncertainty in the March, April time period than now. I think people have realized what is happening. We all have heard our learnings in terms of how the industry sectors are changing. If it's anything particular, I would say the market has a big impact where you're focused on from a market perspective. So if there are companies exclusively tied to aerospace today or just automotive today, then we have figured out ways to move them away from those markets, which are very slow in investments, have their own trouble, and kind of pivoted them to other markets. So there are companies struggling if they're tied to markets that are not doing well, whether it's the restaurant business and so on. But for deep tech kind of hardware companies that I've been involved with, I've tried to mainly focus some of these companies away from the markets that are not doing well to markets where they make more sense. I can talk about some of those examples as well. The other impact is certainly on how do you plan your extended cash runway, right? What can you do in terms of real estate consolidation? What can you do in terms of capex reduction? Which customer do you need to focus on to have a better shot at it? And also kind of helping these companies develop optionalities, because you cannot pivot unless you have tried a lot of things in your career of arrows, kind of multiple options that you have developed over a period of time. So those are the ways to work through it whenever, when these companies are facing challenges in a particular market.
Yeah, thank you, Rajesh. You did talk about, I think you pivot some of the companies from maybe serving automobile industry or some of the other more physical kind of industry needs manufacturing. I think that ties into Ben's early point that, manufacturing automation is more important now, but also I think we'll also see in the automotive space, there are these, I think automakers are embracing more touchless solutions, right? Like gesture controls as well as verbal natural language controls. It seems like that is still getting attention, even that they are serving the automobile industry.
Yes.
Yeah. All right. So Ben, what do you have any views or any kind of examples to show us that the impact on COVID?
Yeah, I agree with everything that Rajesh said. I'll just add a few points. If I have to guess at a high level, I would say, half of the portfolio companies near term are benefiting from the transformation, being accelerated. So overall, I don't see a lot of portfolio companies, getting impacted on the negative side. And I think it's mutual or positive. I think there's probably 25% of the companies that gets significantly impacted. And the way I would look at the impact, not so much the sectors, but we think of it as the impact being a temporary impact or a permanent impact. And the permanent impact are those companies that had a business model that maybe was serving offline businesses and that just will never come back again or never come back the same way again. So in that case, the entrepreneurs, CEOs, they have to really take a hard look at their business model and thinking not so much about surviving the next 6 months, but really have a hard look at the business model to say, hey, coming out of COVID, does this business model still make sense or not? And so that's a difficult exercise, but it's a necessary exercise. And then there are sectors where the impact is temporary. And some examples of that would be, recruiting and HR, for example. So there's no secret that a lot of companies are cutting heads right now. But on the other hand, I'm being an optimist. I believe the economy will take a V-shaped recovery, and people will be needed again. And so after you cut significant headcount to survive as a large enterprise, all of a sudden you will have hiring needs again. And so there are these two. But currently, just in terms of the business environment, I think most of the companies that their target customers are offline services are getting impacted the most. Whether it's travel, whether it's aviation, as Rajesh said, restaurants or hotels, etc. All the offline services are getting severely impacted, and some will go back to the pre-pandemic level, and some won't. And so that's really the business judgment they have to make.
So it sounds like the pandemic is really a stress test for a lot of business as well as the entrepreneurs to see who can actually come out of here, this pandemic strong and probably leading the sector. So that leads to my next questions. How are some of your portfolio company? What are some of the things that they have done, or you have helped them do to successfully navigate through the COVID situation?
Yeah, maybe it's a continuation of what I was saying. So I'll say a few quick words. I think first of all is, if the business is slowing down because of the pandemic, you got to take a hard look to say, hey, is this temporary or is this permanent? And I think that's more important than the tactical stuff. You have to get your direction and your strategy right. So that's job number one. On the tactical stuff, it's actually a little bit easier just because most of the team are working from home. The operating cost is lower, and some of the overheads you don't need as much. And now the third is really getting to the more tactical stuff they need to worry about. That is, how to keep your customers engaged, the logistics of supporting your customers and all that. So every company is different, and it's a case by case how you help them. There's no, at least for my portfolio company, my experience, there's no playbook that you just hand over to every company and tell them to do this.
Right. So Rajesh? Hello?
Sorry, I went on mute for a second.
Okay.
I would say, we look at what new business models the company should be looking at versus what happened before. There's a company in our portfolio that was focused on the professional channel, and some of those professional channels are now closed. The dentist offices are now closed, or people are not going to dentist office as much. And this is a 7-second flossing company. and they're directly going to the DTC, direct to customer business model and getting a lot of traction in terms of interest from consumers. So look at new business models, new channels that you can sell into. The second example I can think of is a 3D printing company that had a lot of traction with automotive and aero, but because of the slowdown there, they shifted to industrial customers and they just signed a $25 million revenue commercial agreement. I think they wouldn't have spent a lot of time on that completely new vertical if this slowdown hadn't happened, but it happened to work out really well in terms of where they need to focus, how they pivot completely in terms of going after a new vertical or a new market. The third example I can think of is, if you're not traveling a lot, let's say if you have businesses in Europe, Japan, Asia and all that stuff, and if you have to slow down because of that, then how do you repurpose the team in terms of looking at what kind of products or features that you need to add into your current technology so that you can come out much better, much faster, when you come out of the downturn. So it's all about kind of reorienting yourself, looking at new business models, new markets, how else can you develop your product better compared to what opportunities you had before. So we just have to develop optionalities and think through all of those options and see how to make yourself successful.
Yeah, this is interesting. It sounds like some of the companies might benefit from this because there might be indecision of the previous business direction. They think it might or might not work, but this pandemic kind of accelerates that switch to a more viable business model. This is very interesting. And some of the question that we got from our entrepreneurs sometimes is it's almost like it's always a chicken egg issue. Here is more severe. It is that company wants to raise more money, right? And to raise more money to create more revenue. But unfortunately, the pandemic hits on the revenue side quite a bit, especially for some of the companies that you talked about. So in these situations, how do you help your companies to navigate through that and say that, well, we wanted to raise more funding, but based on the revenue projections, but now the revenue gets a hit, pretty big hit on the, because of the pandemic. And because of that, and it's harder for us to go to institution to raise the next round of funding. So in these situations, can you give us some kind of advice on how these entrepreneurs can navigate through this situation?
Yeah, I would say, radical transparency certainly helps. Talk through what are the real challenges you face in the next 12 to 18 months, so that the VCs are not second guessing in terms of how can you be so successful when everybody else is struggling. So really talk through, what challenges you face because of COVID over the next 12 to 18 months. And, how are you going to manage your cash? How are you going to emerge better? Because it's not all rosy in the market in terms of, customer traction and engagement with customer and all that stuff. So that certainly helps. Show the optionalities, like I mentioned about. And if possible, try to raise more than what you think you need. And think about how you can put more money into some of those optionalities. And of course, if you're a COVID-based business opportunity, be practical. I mean, I know a lot of diagnostic companies who still come to us and say, they're starting to develop a technology and they're going to be a great solution for COVID diagnostics. The fact is there are 170 companies that are already approved for diagnostics at a lab scale. So it's going to be very difficult for investors to believe that you can take 12 to 18 months and come out to be the winner. So talk about non-COVID kind of peacetime business model in terms of when you come out of the situation, what are the markets you're going to address? How are you going to be bigger and better than everybody else? So just being practical, looking at optionalities, and surround yourself with. If you're a seed stage or early stage company, it's going to be difficult to hire a lot of people. But certainly, surround yourself with good advisors. There are a lot of people who are experts, seniors who have been in the companies, in leadership team in big companies, who really want to help startups. And I've seen a lot of people who are really passionate about helping these companies. So surround yourself with good advisors who can help. And your investors can help you in terms of finding out some of these people. And they can give you good guidance as well.
Mm-hmm. So Ben, to just my previous questions, it sounds like a lot of companies have this trouble, like, hey, do I just lay off my people and maybe switch over entirely my business plan to kind of pivot from maybe a pre-series A stage companies or now all the way to C stage because I have to pivot to raise funding. So that has been a constant struggle for a lot of entrepreneurs. So what's your view on that?
Yeah, I think you have to be, honest with yourself on the stage of the company and not looking at the history of financing, but really, think about where is the company in terms of customers, revenue, product, etc. So the market reality is going to dictate what the terms and all those are. And like Rajesh says, you can look at multiple options. There's existing, investor support. There are other ways to, you know, pad the balance sheet a bit through venture lending if you have good revenue, but you're taking a bit of a hit. So there are other ways if you think your problem is a short-term problem. Now, if you think your problem is a longer-term problem because the customers are not coming back, if you serve small businesses in the restaurant sector, maybe 20-30% of the restaurants will never open. So I think first of all you got to look at your problem whether it's long-term or it's short-term, and that fundraising is a process of sharing your vision, your belief in the company long-term to investors. And that's an exercise whether you do it with your existing investors or external investors. Ultimately, you're setting a story that is not a 6-month story, not a 1-year story. Very little analysis that we do in making an investment decision is short-term focused. We're always thinking what this could become in 4 years, 5 years time. Even with our portfolio companies, we're looking at a relatively long-term horizon. And so, you got to deal with the problems short-term, but in fundraising, you can't sell a 6-month story. You have to think about a year, 2 years, 3, 4 year out, and think accordingly and pitch accordingly.
Well, thank you both for that advice. Hopefully that's helpful to some of the entrepreneurs in the audience. I think I come to my last question. Again, this is a lot of people really care about is what are some of the effective ways to fundraise from VCs under COVID, and also just more specifically in the deep tech space or hard tech space. Is oftentimes we found that in the past we could go to the company's lab to look for the demo or look at their devices or whatever they have, right? In deep tech, oftentimes you do have these things. And under COVID, and it seems like it's just a virtual demonstration doesn't really cut it, right? Because you really can't see for your own eyes. And so what are some of the effective ways to communicate to fundraise from VCs under COVID? Rajesh, can we start from you?
Yeah, we get people reach out to us all the time. You don't have to come through somebody that we know for us to look at investments. In many cases, these are cold calls. People have reached out to us with texts. So just continue to do that as well. I mean, don't shy away from reaching out to people. It's always better if you know somebody who knows the fund and they can put in a word. But certainly, reach out to all the funds that are investing in the space. And there are hundreds of funds. So make sure you're reaching out to funds that are investing in your area, who have a sweet spot for or an expertise in the area that you are investing into. Otherwise, it's a significant sink on your time. Second, I would say, I think particularly for the COVID world, I think it's a very good idea to be engaged with platforms like Propel or YC or SOSV, because they are organizing a lot of these events, and it gives a good visibility when they conduct these competitions, panel events, or startup pitches, to get an exposure in a single place to a lot of VCs, because I've seen myself joining some of these startup pitches online more than what I used to before, because everything is online now. So definitely leverage these platforms so that you can make the best use of it. And certainly, like I said before, have a good set of advisors. So when you send out the deck to investors, get some credibility, some third-party assessment on what you do, why you're unique, capture that in the pitch, because that would certainly capture the VC's attention.
Ben?
Yeah, agree again with everything Rajesh says. I would also recommend, and do this with my own portfolio companies in the deep tech space, to make the PowerPoint a little easier to understand. Historically, all the hard tech companies, the business plan looked like a research paper. And you know, these days, I would say the volume is high, and you know, sometimes you don't get to see the person initially, and because of that, to explain a very difficult concept over Zoom is a lot harder than do it in person. And so thinking through how to dumb it down a little bit, and you know, while not making it too cartoonish, right? But you know, make it easier to understand for the first meeting is becoming more important. I had been looking at a company in you know, compound semiconductor on silicon kind of growth, the stuff that Khosla is very good at doing, in fact. You know, normally I would just do it in the conference room. So beyond the slides, you know, we got a whiteboard, and I would ask dumb questions, and the founders would draw things on the board, and you know, watch my facial expression and see if I'm totally lost or not. But you can do that over Zoom easily, and because of that, it's really important not to go too deep too quickly, but really, you know, even practice with your friends who are not technical and see if they could understand what you try to explain to them. And so that's one advice I would give for deep tech companies. And in terms of due diligence and looking at the lab, it's not as big of a problem as you think. I mean, companies are open, and in, you know, a couple of occasions where we're looking at deep tech companies, I go there to the lab and I check it out. Now, it's not crowded like before, and you do have to do social distancing and wear masks and all that, but you know, all of us are working, so that's less of a problem.
Got it. These are super useful advice for, I think, for you know, entrepreneurs in the audience. So I think that is my last question. I do see a lot of interesting questions from the audience. So Andy, do you mind actually taking the questions and read out for our panelists too?
Yeah, I'd be happy to. I think there's one in particular that relates to our current conversation. This is from Charles Yap, who's a kind of a leading roboticist that is in our deep tech network. He just talked about how are you handling remote diligence? And I think we've addressed that to a certain extent. And I would maybe reframe the question. Are there tips or best practices that you've kind of come up with in the last few months for staging the diligence process in a way that makes sense given working remotely? So Ben, you mentioned kind of initiating the conversation with something that's a little bit easier to digest. And Rajesh, you mentioned continuing the cold outreach. But let's say you're getting into the stage of actually diligencing. What are things that you found to be useful given the conditions that we're working under? And how would that kind of help both investors and entrepreneurs negotiate this process a little bit more efficiently?
Yeah, one aspect I find useful even before the COVID times is take a good video of your facility, what you're doing, even if it's a 5-10 minutes video. It goes a long way versus just communicating over a PowerPoint slide on what your lab setup looks like, how are you making the device, what is happening. You know, it's particularly relevant for deep tech and hardware companies. That gives investors a comfort level around, you know, what does this team look like? What does the setup look like? How are they making this stuff? It's a good feel for how things are done, how it's manufactured. So it's not just PowerPoint. Because if that comfort level is not there, the default you know, position for a VC might be, I don't know enough about it. I don't know if it's credible. I'll just pass on it. So if you can increase that credibility and give a more, a video can go a long way.
Yeah, I agree. You know, and I won't say the due diligence process is a whole lot different from before. A lot of the same things that we're looking for is the same. And the part that tends to get lost, not having too many opportunities to do in-person meetings, which we still do some, and is that so nuances in personal characters and all that. And I would say one thing that we increased quite a bit is on the personal references side. We tend to invest in people that either we knew or our co-investors know, or we know through some connections. But despite that, maybe we used to do 4 or 5 reference calls, and now maybe we do double that. And And we're not trying to figure out, is this person a good person or not, and that basic stuff. We're actually trying to understand the person better in terms of, what he's great at, what he's, learning that skills from. And for example, one of the investments we just made is a online media company, and that requires the skills of getting the product right, getting the vision right, user acquisitions, and all that, and this goes on and on. And so we take the time and called multiple references and prior companies and all that to see where the skill sets were acquired over that time, and what he's great at, what he's not. So we do a bit more of that, but other than that, I would say, the check boxes are still the same, and we do whatever we can to tick off the check boxes.
Great, thank you both for those answers, very thoughtful. There's a question that's very specific, and again, I'll probably try to reframe it in terms of a broader question. This is from Tom Degnan, and I'll read it out. Can someone comment on VC investing during the next 2 months prior to the election? Given that there were very different business policy approached by the two candidates, does the industry pause during that time? And so that's a kind of general question about risk. And I think that one thing that's happened is that we've all experienced that the world can really change dramatically in a short period of time. So let's specifically about the politics of the US presidential election, and more globally about risk. As we do go through these changes in society, in the world, that are dramatic and relatively abrupt, how do you think about your time horizon and the different sets of opportunities, and balancing kind of the feelings of the moment against the different opportunity sets of the long term? And this is maybe more of just a personal philosophical question that I think is probably pretty unique to each person.
Yeah, at a seed and Series A level, I'll rush past the question in the interest of time so we can take up more. At seed and Series A level, we really have never talked about an election, at least in our last 9 months. I mean, we make science-based investments. So if we have to start thinking about elections and science versus no science in some of these policies, then I just have to stop working on venture. So this is really not a criteria we look at.
Yeah, it's same. This question is probably more applicable to mezzanine run investor who is trying to put $200 million into something that's cross-border, but it's completely irrelevant to us.
Mm-hmm. Yeah, so that's I guess the framing really around just thinking about different risk horizons, and if there are things, kind of just balancing the sensation of being in society at the moment with those longer horizons. How do you as a firm think about I guess the experience that many people are going through, and particularly, I mean, you mentioned restaurants or the shifting in business model. Are there ways of thinking about risk at a broader sense, that kind of abstract people's experience of the day-to-day volatility versus the changes in investment horizons or opportunities? I think one of the questions that also comes up, and we quickly have time to address it, is really just around valuation sensitivity. So it's a pretty popular question, and I think it's a pretty easy one to answer. But have you seen a dramatic shift in valuations in the last few months due to COVID?
Yeah, since COVID, since March, I would say there are almost two different periods. I think there were a lot of fear and uncertainty in March and April, where I saw valuation trending down, or investors getting pinged by founders who had raised money, maybe didn't raise enough towards the end of last year, coming back to the market and essentially opening the rounds up again for additional capital, which we maybe missed out on, was difficult to get into, and what have you. So so that was in March and April, maybe into May a little bit. But in terms of capital raise for good companies, having momentum, I think through the summer, it's been very, very, very competitive. And I certainly did not see any discount. If any. Maybe for the good companies, they're getting a premium valuation compared to last year. You know, I won't read too much into it. You know, our industry has ups and downs and hype cycles and what have you. But at the end of the day, you know, entrepreneurs should focus on getting good investors and right investors who, you know, supports your vision and all that, instead of worried about, you know, a little bit down on valuation or a little bit up on valuation. Market is going to dictate that. And if you have control over when you need your money or when to raise funds, then, you know, use that option. But otherwise, the valuation is going to be what the valuation is. And just getting the right investors, top priority.
Very sage advice. So we are at the end of our hour, and I think that we should respect everyone's time. I know that everyone has a lot of meetings to attend to, and so we should wrap up the call today. Lisheng, I'll let you close the conversation, but thank you everyone who joined. Thank you, Ben and Rajesh. But Lisheng, I'll let you close the call.
Yeah, well, first of all, thank you everyone who participated in the call today, and especially thank Rajesh and Ben, two veterans and longtime friends to PropelX to be here during this busy time. Apparently, you guys are very busy, even busier than before. So really appreciate that. A lot of great stuff, good advice to entrepreneurs and investors alike. So again, thank you, and best luck in your investing. In the next, I don't know, 6-9 months. Hopefully, get some kind of good unicorns down the road. Thank you very much.
Thanks for the good work you guys are doing. It's very important to have platforms like this for people to be able to reach out to a lot of investors, not just about this panel, but what I'm talking about the PropelX as a platform itself. It's a very innovative approach. So good luck with what you're doing.
Yeah, thank you.
Appreciate that. Thank you.
All right, everyone, take care. And with that, we're ending the call today. Thank you all.